Hi, Emily. Thanks very much for joining us again. Great to catch up. I'm really keen to pick your brain about what you're personally seeing out there in markets and just get a bit of an update on how the JP Morgan Emerging Markets Investment Trust is positioned and how you see the outlook. It's obviously still a vehicle that we favour when we're looking to get exposure to emerging market equities. So looking forward to the catch up.
Excellent, me too.
Right, where shall we start? I guess sort of at the midpoint of the year, things were looking very good. It was a very strong first 6 or 7 months, and now we've had this bout of volatility. I think most markets are still in positive territory, but things have subsided in terms of that enthusiasm, haven't they? So, interested in how you're seeing the performance year to date of emerging market equities, how you're feeling about the outlook, particularly in light of the recent ups and downs, and sort of the prospects for that part of the equity markets in general from here on.
Okay, well, look, first of all, thank you as always for having me. It's always great to get the opportunity to update you all on what we see happening across emerging markets. And I think, as you correctly point out, there is a fair bit going on, not just in EM, but across global markets right now. But if we go back to the last couple of weeks or previous to that and think about how EM had performed so far in 2024, I think you could argue it's been fairly solid, but fairly mixed. And I think this is always a good reminder of quite how diversified emerging markets are, that we talk about it as a block of an asset class, but actually it's made up of very different markets at very different stages of their business cycles. And this year, like so many, has reminded us of that. So if I think about Asia, it had very much led the way with the likes of both India and Korea and Taiwan performing well. In contrast, Latin America has struggled off the back of the pushing back of Fed expectations. So you've seen quite a split by region. But I think overall, when you look across the asset class, we see economies that are in aggregate in very good shape. Markets where central banks have room for maneuver, and I think have shown themselves to be very sensible versus maybe where they were in previous cycles. And that for us as stock pickers puts us in a really good position that we continue to find a lot of very good companies that, even though maybe the economic backdrop isn't as strong as people would hope, there are still companies out there that are run in a very strong fashion with good quality management and with a great ability to build and grow their market share. The one other thing I just wanted to do was to add a couple of numbers so that all of our listeners really understand quite how mixed the year has been. India and Taiwan are both up over 20% in US dollar terms. This was to the end of July. In contrast, in Latin America, which, as I said, has struggled, having been the winner last year, Mexico, Brazil, both down more than 15%. So a very big spread. And I think, once again, just a reminder of, for this asset class, you want to be actively managed, right? You want to be able to take the opportunity where to be and, importantly, where not to be.
Yeah, thank you. Really good point you make, and a good reminder for all of us just about that diversity across the emerging market sort of spectrum, because some of those regions are completely different, aren't they? So glad you started with that. I'm keen to drill down on a couple of parts of the world. Hard to not start with China because it's such a big dominant region, particularly down here in New Zealand. We have very strong links to China. So interested in how you're seeing that economy and market. It's definitely been pretty mixed in recent years and feels like some of those challenges that the economy is facing will persist for quite a bit longer. So what's your current take on China, and how are you approaching China or China-facing businesses from an investment perspective? Are you positive, negative, somewhere in the middle?
Well, I think I'd use the word mixed again, so to take some of the words out of your mouth. But I think I would start off by, again, making a point, hooking onto something that you mentioned. There is a big difference between the economy and the market in China, as there is across the world. And I think that's always very important for us to remember, that I think historically people have got very hung up on GDP growth numbers. And yes, they are very important. That's giving you the backdrop for these companies to operate in. but you very rarely see a tight correlation between GDP growth and markets. Markets is very much about the underlying strength of businesses, and that's clearly what we are looking for as stock pickers in this product. But China, I think, the headline I would almost put over the market is one of lack of confidence. And until you see that shifting, it's going to be difficult for China to keep performing. You see a lack of confidence from corporates across China, who understandably, in a weak economic backdrop, aren't wanting to invest and necessarily grow their businesses. You see a lack of confidence from the domestic consumer, and you will have all undoubtedly seen the headlines about the slowdown in consumption in China, and that clearly has a very big impact on the economy. And that's all filtered into a lack of confidence of international investors, who, when you look at surveys globally, global international investors are at one of their lowest rates in China ever. And that shows that A, there's a lot of money on the sideline, but B, we need to see something that shifts to encourage the confidence to come back to all three of those aspects. And I think what we've all realized, unfortunately, is despite the hope of the reopening doing well for China, it's going to be a very slow burn. And so we need to be very thoughtful about where we invest in China. It's still a huge opportunity to us, all right? It's 25%, it's a quarter of the emerging markets index. You all know the demographic numbers and quite how big the population and clearly their ability to spend is. And so for us, it isn't an area that you want to ignore, but you want to be thoughtful about where you're investing. And so, for example, I mentioned the consumer, and we've always liked the Chinese consumer story. Right now, they are in what you could term a down trading cycle, right? They've got concerns about their wages and ultimately their jobs, on top of the wealth effects that's gone negative from property. And so therefore, think of them just about trading down a level with pretty much everything they're spending. So going from premium brand to own brand in a supermarket, just as a very easy example. And so what we want as investors is companies that can work through that product profile, right? That don't just aspire to sell to the very top end, but have something that suits every pocket. And so for us, it's about finding companies that have the ability to maybe pivot, but have strong brand name and strong loyalty as well. So we think that China continues to be an exciting opportunity long term. I think we have to be realistic to it's not going to bounce back anytime soon. But as much as it has been difficult, it's too big a market to ignore and not invest in. It's just very much about digging around and finding what we perceive are the best companies based on the new future, not necessarily what we saw from China historically.
Mm-hmm. Turning to India, which you touched on in your earlier comments, that's a market that we really like. We find it very interesting. Obviously, the demographics are very positive, and there are a lot of things to like about India. I mean, we had an election, didn't we, and a bit of volatility around that time. But as you rightly pointed out, it's been a great performer this year. How do you see India at the moment? Is the opportunity still strong after that good run? And are we right to be as interested and encouraged by what we see in the Indian economy and market on a long-term view?
I mean, it's an interesting one to follow China, because I think you go from one end of pessimism to the other end of optimism. And I think India is clearly full of optimism. It's exuberant right now when you speak to any corporates, when you speak to the population, when you look at companies and what they're talking about. As a result, and the strong market rallies that we've seen in the last couple of years, I think you could argue that it's getting close to being what I would term price to perfection. It's looking quite expensive versus the rest of our opportunity set. And as much as you highlight all the key long-term drivers, right? Demographics, it's earlier on in its urbanization trend. You've got, I think, almost 500 million projected to come through into the middle class in the next 5 years or so. So there's a massive middle class emergence and consumer story as well. You have to be careful about what you're paying. And so we do like India. We like India long term. We've actually been trimming some of our exposure into the market strength. And the reason for that is more when you consider that we are emerging markets investors. India looks great, but we need to realize that there's other areas that we think offer better value. I would say about India, long-term fantastic story, but to us, as investors right now, you need to be thinking in years, not months, if you're trying to get in, purely because you're being asked to pay an awful lot. And you're right. I mean, what now looks like a very small amount of market volatility post the election has pretty much dissipated. Modi stays in complete continuity with him and the vast majority of his cabinet. So there's an awful lot of good stuff about India. It's just therefore being careful of the valuations that you're paying. But optically, yeah, fantastic market for us, I would say.
Right, really interesting points there, isn't it? Because it's that difference between fantastic fundamentals, but are we overpaying for that? And I suppose it's not dissimilar to what we've seen in some of the US growth and tech stocks lately, isn't it? Fantastic businesses, wonderful prospects, but at some point they become a little pricey and the investment opportunity is not as strong. So I think there's a lot we can take for that. We won't get into tech and so forth. We'll be here all day, but I do want to touch on a couple of those macro factors that you've touched on. Inflation, rate cuts, all of those things that are going on in the world. How do you think that will impact emerging market economies and currencies and equities? Because we've seen the Bank of England, the ECB, the European Central Bank already cut rates. The Fed doesn't seem to be very far away. Markets are very excited about rate cuts over the balance of this year. How will is that typically a good thing for emerging markets if you see a bit of US dollar weakness and lower treasury yields? How is it all interlinked?
So yes, you are right. Typically, all things being equal, a weaker US dollar and Fed rates coming down would be net positive for EM. However, I think as we've seen literally in the last couple of weeks, maybe the world is slightly different in terms of it depends on where you are in the market with these things happening as the ultimate impact on EM. I think we've been continually reminded over the last couple of years that volatility is inherent in emerging markets. That's basically why they're still called emerging markets. And so we seem to, you often get the more extreme reactions that filter through to emerging markets. And we've definitely seen that post the weak US jobs report, the Bank of Japan moves, and the ultimate impact that you've seen in different markets, most notably in North Asia with both Korea and Taiwan falling very sharply, pretty much bouncing back to where we are at least today. So yes, all things being equal, it should be a conducive backdrop for EM. What I would caveat that with, and clearly there is so much written about all of this, too much for even all of us to digest in our daily lives, is it will be about the speed of the rate cuts from the Fed, because that will give us a very good indicator about the health of the US economy. And clearly the US economy is the major economy in the world. So as much as Fed cuts are positive, if they come down too much too soon and in sort of bigger magnitudes, that can actually send a more negative signal, because that could be suggesting that they feel that there is going to be a hard landing, which is clearly negative for everyone, right? That brings us closer to a global recession. That's not the JP Morgan base case right now, but that's why I think we need to be fairly careful about what we mean by Fed coming down is always good for EM. So I do think we're in a good position. I mentioned earlier that the vast majority of emerging market central banks are sort of primed and ready to cut. They've been very sensible and they were ahead of the curve in putting their rates up. They're now ready and have room to maneuver to bring down. You've already seen the likes of Brazil, Mexico, Czech Republic, Chile cut rates this year. They're ready to go further, and they have further that they can cut, for which we see some really positive outcomes, again, all things being equal, with the likes of credit growth picking up again, especially in Latin America. And that's part of why the pain has been felt in that region in particular this year, because the market was ready for these cuts to come through from the Fed. Remember, start of this year, 7 rate cuts were anticipated. That was seen to be really good for LATAM because credit growth is so beneficial to the economy. It hasn't, but we still have hope that it will drip through. I just think where we sit today is very different from where we sat in January based on expectations. So it's a case of watch and wait, but knowing that these EM central banks and economies are in a far stronger and stable position than they maybe were in historic portions of this cycle.
Mm-hmm. So we're all watching the Fed and other central banks to see when they move and how quickly they move. The other major development that will be upon us in the months ahead will be the US election. And can you tell us what you're sort of watching there? I'm not asking for any predictions necessarily, but whether it's the Republicans, whether it's the Democrats, you've still got potential trade policy issues to worry about, keep an eye on. How are you thinking about that election and what it could mean for emerging markets? What is it that sort of is most important in terms of policy change or potential flow-on effects there?
Well, it's been very much an election year globally. So within emerging markets, you referenced earlier the Indian election, so largest election in the world, took 6 weeks. We've had big elections in Mexico and in South Africa. And the reason I highlight them before we think about the US election is the ultimate result, the market essentially got right. But the market reaction was very different based on either the strength of the victory. So in Mexico, there was a super majority that was won by Sheinbaum, and the market took that as negative because they were concerned there was too much power sticking with that party. In India, if you recall, there was volatility when the exit polls came out in the sense that Modi wasn't winning as much as anticipated. So what that automatically reminds everyone of is never try and position yourself for an election, because even if you get the result right, you might not get the market reaction and how it's perceived accurately. So we're trying to look through a lot of the election volatility to cut a long story short on that. However, there are clearly a lot of headlines and rhetoric around the US election based on who wins. What we're not trying to do is second guess any of it. It's a very dangerous game. When you look historically about the performance of markets, there's very limited correlation based on whether it's blue or red in the US. But what I would say, and we saw this in over the last couple of cycles with US presidents, is that there are clearly more politically sensitive industries, especially in China. And that's where our stock picking comes into play, because it's recognizing that there could be external factors that impact companies. Remember, we want to be buying companies who are ultimately in control of what they can deliver. It's partly why areas such as the consumer are so attractive, because regardless of whether I tell you who you buy your electricity from, I'm going to struggle to tell you what brand of shampoo to buy, nor is any political party. And so I think that as much as the US election will cause volatility, there's going to be a real pickup in the rhetoric, especially around China, I suspect, in the run-up to the election. What we're not trying to do is position ourselves, but we do want to be aware and have our eyes open into which markets could potentially be impacted and which sectors within that. And we build a lot of that into our stock assumptions. So just as one example, a Chinese lithium battery manufacturer who supply a lot of the EV companies, we have assumed going forward close to a 0% market share in the US. So we're assuming that that business runs without ever gaining a foothold into the US. Anything in the US would be a bonus, but we need to be very pragmatic to a lot of the news flow coming out from the election candidates.
Very good points. Very wise way to sort of approach politics, which is always difficult to predict at the best of times. Let's wrap up by I'll wrap up by asking you if there are any specific industries. You've touched on a few, consumer and so forth, but any more you'd like to share in terms of industries that you particularly like at the moment, or regions? We've got your view on China, got your view on India, but lots of other parts of the emerging market spectrum. So are there any countries that stand out that you're particularly interested in, countries or sectors/industries?
Always. So I think the beauty of investing across emerging markets as active managers means there are always opportunities out there. It is such a broad asset class that regardless of what's going on in the world, and clearly there's an awful lot right now, regardless of external factors, we can still find very well-run businesses. And I think what you see from emerging markets today is very different from the EM of old. Across the asset class, you have what are global leaders. You will have all undoubtedly heard of Taiwan Semiconductor. You've heard of Samsung. You've heard of Lenovo. There are a lot of fantastic, innovative companies coming out from EM. And I think the innovation side is where we see at least broad opportunity. It doesn't always make its way into the trust because we want to be long-term, and some of them maybe don't yet have the economic track record that we want, but it shows you the ability for these markets to generate good companies that in time might fit in. So I would highlight areas such as semiconductors, where Taiwan dominates. Over 90% of semiconductors at the high end, the cutting edge, come out of Taiwan. Memory, where Korea is an absolute leader. You've got the EV space, and you will have undoubtedly all read headlines about EVs coming through into different markets coming out from Asia. And then also solar. Solar is becoming clearly very big across the world, and China are the market leaders there. For all of those areas and all of those industries, there are a huge swathe of investment opportunities, not just from the finished product, but all the way through to the components, the component manufacturing, the design, and so on. So I think the cutting edge side of tech is an area that EM really leads on. The other area is clearly, as I said, being the consumer side. The long-term story of emerging markets, to my mind, continues to be the same as it has been, which is the fact that over 82% of the world's population live, work, and consume in emerging markets. And as they earn more money and they demand more and they consume more, that's got to be a good thing for those businesses. So it's always an asset class where we see a lot of negative or uncertain headlines. We've clearly been in the shadows so far this year and the last couple of years from the US and especially the Mag 7. But I would argue that there is always a place for EM in portfolios purely because of the breadth and the opportunity that we as stock pickers can go out and find.
Fantastic. That's a great way to finish. So thanks for those insightful comments. You've covered a lot of ground there. I found that very useful. I'm sure our clients and listeners and viewers will too. It's the evening here. It's the morning where you are on the other side of the world. So I'm sure you want to go off and get on with your day, and I need to round up my children and get them off to bed. So we'll leave it there. Thank you very much, Emily. As always, a great session, and we'll hopefully talk again soon.
Excellent. Thanks, everyone. Stay well.
For more insights, visit craigsip.com.